Welcome, ADK and Financial Planning World community. Dan Davis, ADK President and Co-founder, Financial Planning World Co-founder. Our focus today is simple. It's economic news and financial market updates, really focused on equity markets. I want to really cover a few things. How did we get here? Where are we now? What have we been doing for you? And then our outlook, and then sort of wrap it up. If you really take a look at how we got here, it's very unique. In my 34 years of managing money and doing financial planning for you, I've not seen anything really remotely like this. This has similarities of multiple different things. But if you really oversimplify, if you go back to December of 2021, the economy was doing extraordinarily well. All of the dashboards that we look at for economic data supported the theory that we were in mid-cycle. And as you recall, you have recession, which is an end cycle, recovery, mid-cycle, late and end is where the recession is. So kind of in the middle of everything. And historically, that full cycle is about 7 years. So we thought we probably had another 3 to 4 years left before we'd be sitting where we actually are today. And so the Fed, no big surprises in that the Fed began raising rates, but at the point that we're still referencing, they were saying that they believed that inflation was going to be transitory. So that kind of language would lead you to believe that the kind of raising of rates would be normative. If you then fast forward into February, the Fed was raising rates, you then had Russia attack Ukraine. And if you said, well, what was most belief around what would happen with that? Well, if you go back to what Russia did with Crimea and Georgia, the West really did nothing other than, say nasty things through chains of command and PR and all that, but really just let them take it. This response was very different, and I think very appropriate, as a matter of fact. Maybe even a response could be even more robust than what it was, but clearly this response was significant. And the issue around there is, with that kind of response, it creates another layer of inflation, which is what the Fed's been having to fight. In this inflation, no one knows how transitory or permanent it is, because you don't really know how long will the war go on, nor do you know when the war is over, what's the state of affair. Things like wheat production can get cranked up pretty quick. I mean, it takes a farming cycle. But things like steel manufacturing and some of the things that they do, you just don't know, is the whole infrastructure decimated and they have to rebuild if it even happens. So somewhere between transitory and intermediate term to long-term effects. I'd say, though, that the really bigger thing you don't really hear much about is the supply chains. And when you do hear about supply chains, it's mostly around COVID. But in our discussions with money managers, about 85% of the supply chain issues are what we will classify as transition away from China, bringing some things back inside of their own borders. In the U.S. case, a lot of pharmaceutical, et cetera. In many other cases, it's distributed around Asia. The issue around that is China's kind of a one-stop shop. You bring it there, the capital's already there, the machines, and it's large where you can do A to Z there. Well, if you move manufacturing to Vietnam, you're not A to Z. So now we have inflation that's not transitory. The supply chain increased cost, that's here to stay for a while. I'd say 5 to 10 years. And then lastly, you've got China's zero COVID policy. That is probably transitory. So then you say, okay, well, the inflation mixer causes the Fed to have to do more. The Fed doing more creates all kinds of disarray. In mid-June, June 16th, we hit a year-to-date bottom, which at that particular point seemed like it was a rational stage where markets had gone down, probably start to recover, which they appeared to do. And then if you say, okay, well, where are we now? Where we are now is that wasn't a real beginning of a recovery. It was just a run up, and then call it mid-August through today even, the markets have been sort of on a downward trajectory. New lows have been set. The economic dashboard is probably the biggest thing of interest, in that if you take a look at where we are right now, it's the fastest time period from all green to flashing red, and flashing red basically means recession is imminent, and then it's guesswork as to how far off. If you take a look at the ISM, which is one of the 12 components that's measured, it's shifted red this past month. Historically, when it shifts red 6 months later, plus or minus a little bit, you see a recession. The Fed has had a unique period where its employment is super strong, so that part of their dual mandates is secured, so they can really fight inflation, and so they've been raising rates, I'd say behind the curve, but very, very strong. And I believe that will probably continue. Why is that? Because inflation is stronger than what anyone's expected, and it's not just U.S., it's globally. There's things that are happening that I alluded to as supply chains. There's also the stuff with China, Russia, and none of that is an easy solution. I personally think much of what the Fed's doing is necessary because I think there's a really good chance that we've concluded a really long cycle of low inflation. And if they don't do something, we could enter a next cycle of higher inflation. I don't know that we'll go back to the stagflation of the Carter administration, but clearly we're at a tipping point with inflation, and I believe that the Fed's doing what needs to be done to fight it. There's a lot of unintended consequences of that, but that's a whole nother video, if you will. The next point is really, what have we been doing for you in the midst of all of this? So if you go back to that June low that we mentioned, we used that as a buying opportunity to increase your technology exposure. Time will tell whether or not that timing was good or not, but I feel good about it because we were able to buy things that we really like, that are part of the economy, that are probably great investments long term. Like I said, started to recover and then pull back down. We're below where we bought them because the new lows have been hit. The other things that we've been doing is what more recent. So if you think of a term called capital market rotation basically says you move from one type of a security to a similar type. It's like a red apple to a yellow apple. So a good example, in the 2000-2001 financial market, you know that we hit what we call the dot bomb, and markets were collapsing in the large cap growth. But if you take a look at publicly traded real estate and you take a look at small cap value, they did really well. They did super poorly for the 5 years leading up to that. And so markets rotated out of something that had done really well into something that had lagged. We're believing some of that's happening right now. So some of the capital market rotation that we've done has moved out of some of the growthier assets and moved into small cap, and we've moved into some energy. I don't believe that either of those two are long-term plays. They're short to intermediate-term plays, just capital market rotation. We're trying to eke out some small returns instead of losing money would be the easiest way to sum it up. Investing involves a lot of risk, so it's hard to say, will that work? But we're attempting to manage risk for you. We're not just sitting hoping. And then more recently, when in mid-October, a bottom was penetrated through the June bottom, and there was enough technical signaling that we felt like there's enough risk that another drop of 15 to 20% is possible. So we reduced your emerging market exposure, and we reduced your U.S. large cap growth, and that money right now sits in cash. I'm going to back up to when I said that the capital market rotation, what we rolled out of was international developed world, i.e. Europe. We're really concerned that what Europe's going to experience this winter is just going to be nothing like anything we've seen since like World War II, when you do food and energy and the debacle that Russia's created. So there's more possibly that's going to have to be done if the markets continue dropping. There will be more we do. Our outlook, if you oversimplify it, there's many scenarios that can play out, but it's really pre-election and post-election. Pre-election, we expect a lot of volatility. I wouldn't even weigh in and say that I think the market's going to go down, sideways, or up. A lot of times I have opinions, but right now we've got so many mixed signals, it's just impossible to even predict. I do believe on the other side of the election, barring some kind of a worsening with the Russia war, that the markets will get a bump. Again, time will tell. If that does happen, we will use a potential run-up at that stage to reduce equity exposure, because our outlook is that a recession is imminent from the dashboards. As I have mentioned, if it's 6 months out, that would mean that we're talking sometime in Q2. So if that happens, what's hard to really interpret historically, when a recession happens, the markets they pull back before, and then in the midst of the recession, they typically start to recover even before it makes sense based on headline news. What's hard to say is the pullback that we've seen, that we're in, is that it? Or is there more coming as a result of it? The reality of it is that that's like the $10 million question that no one knows. We're diligently researching and being nimble to make sure that if the risk of that is high, that we'll do adjusting to make sure that you're not getting pummeled. All of that said, I know it's been a super hard year. I've had conversations with many of you. I understand what you're going through. One, I'm invested in that. My mom's invested in it. My income's directly tied to it. All of that said, this is your life savings, and you've entrusted it to us. We appreciate that trust. We're working diligently for you. We'll continue to do that, and I thank you for your trust. We'll keep you up to date. We'll be doing another one of these after the election's over with, because that to me is sort of the reality of pre-election, post-election. Where are we at? We're here for you. If you need anything, just simply reach out to Sam, Rich, Justin, or Scotty to get an appointment scheduled. If you don't need anything, we'll be reaching out to you. Signing off from St. Louis, we're here for you. Have a great day.